I'm Jay Taylor. I'm the editor of Jay Taylor's Gold Energy and Tech Stocks. I also host a weekly radio show called Turning Hard Times into Good Times. It airs on the Voice America Business Channel. And writing my newsletter since 1981, so I've been around the junior mining sector for quite some time. I'm really glad that you've joined us here at the Metals Investor Forum. We're going to be talking to 5 company guests that I've invited to the show, and then we'll have questions and answers. And you're welcome to send in questions, and we'll try to ask our company spokesman for answers to those questions. So I'm really happy to get underway here on a day when gold is up some $18 or so at the moment as I'm speaking. Next slide, please. I've titled my talk today, "It's Much Worse Than You Can Imagine." Not the economy, not COVID-19. I think this chart illustrates why I'm talking about it being much worse than any of us can really imagine, in a sense. If you look at the arrow at the top of the chart, it shows the job losses, the monthly job losses in the great financial crisis, 2008, 2009. Those are monthly job losses. You can see we lost 20.2 million jobs just in the month of April alone. And so 36 million Americans as of this morning have filed their jobless claims or unemployment insurance in the United States. We've never seen anything like it, and the rapidity of this is much worse than the 1930s. Next slide, please. Just another measure of the severity of this rapid decline. This shows the number of employed people, that it's actually plunged back to the levels of June 1999. It's just a breathtaking decline here in terms of full and part-time household survey. Next slide, please. Every time we have a credit cycle, the powers that be, central banks pump up the money supply. They create money through the fractional reserve banking system, and they push it until the system breaks down. When the system breaks down, the market is trying to find equilibrium, but the establishment won't allow the free market to work, and so they push more money again to create more money out of debt. The fractional reserve banking system kicks in, and people have quite a party until the system breaks down again. So 2008 was the first time we had quantitative easing, and I'll talk about that, as well as the next extreme step that I think will be taken, and that's modern monetary theory. I'll talk a little bit about that in just a bit. But the COVID-19 clearly is causing the Fed to kick into overdrive, creating money, essentially creating money out of nothing. Next slide, please. How did we get here? Well, I happened to run into a newsletter that Stephen Roach wrote back in 2004. I used to read his things almost every day when he was an economist at Morgan Stanley. He covered Asia for Morgan Stanley. And he said, I think that really sort of sums up why we're in such dire straits right now. He said, and I quote, "The world economy is on a collision course. The U.S., long the main engine of global growth and finance, has squandered its domestic savings and is now drawing freely on the rest of the world's savings pool. East Asian central banks, especially those in Japan and China, have become America's financiers of last resort. Breaking points are always hard to pinpoint with any precision. Most serious students of international finance know that these trends are unsustainable. But like any trend that has gone to excess, a group of new paradigmers has emerged with a compelling argument as to why these imbalances can persist in perpetuity. That is usually the sign that the denial is about to crack, possibly sooner rather than later." Well, Stephen Roach wasn't right about the sooner part, because I think it's only happening now, perhaps in a lethal form, potentially something much worse than 2008 that may change the political and economic landscape as well as geopolitics, I'm afraid. Anyway, the bottom line of Stephen's message was Americans are spending too much and saving too little. Next slide, please. So traditionally, up until quantitative easing, there are a couple of different models. And I give Lynn Alden, she's the founder of Lynn Alden Investment Strategy, credit for this slide and several others that I'll be using. By the way, I've thought so highly of her work that I've asked her to come on to my radio show next Tuesday. She'll be a guest for the first time. This is one of several slides that she's responsible for that I'm showing you. The simple way that governments traditionally financed their treasury was just simply by borrowing from its own citizens and taxing them. But of course, after 1971, when Nixon took us off the gold standard, the United States was free to create money out of nothing, enforced by its military, of course, to ensure that countries did what we wanted them to do. We created enormous amounts of money. We created enormous amounts of debt, which foreigners increasingly financed. And that's what Stephen Roach was complaining about in 2004, that we started relying on too much on the kindness of strangers, essentially. Next slide, please. So we borrowed massively. About the time that Stephen Roach wrote that article, our foreign, this federal debt holders by foreigners was something about 15% or so of GDP, and then it spiked up to 35% after the great financial crisis. It's come down a bit now. It remains to be seen whether foreigners will jump in again, but we'll have to find out. There's some variables that come into play. It seems as though foreigners borrow more when the dollar is weak, and when the dollar gets strong vis-a-vis other currencies, they tend not to borrow. So if the dollar gets really weak, will the foreigners come in again? That remains to be seen. Next slide, please. This is a metric that I think really shows the decline in the United States in a financial sense. Negative 52%, which you see next to the United States name. What that means is that foreigners own 52% more of our assets than we own of theirs. So in other words, the world, the rest, people outside of the United States owns a big part of the United States. And so we are beholden, and some would argue very much so right now, to the Chinese. And there's very little we can do, probably, without severe repercussions if we want to hold the Chinese responsible for various things that some people think that they've done, especially related to COVID-19. But you look at some of the other countries like Singapore, Norway, Switzerland, Taiwan, all very positive numbers. That means that they own much more in other countries than other countries own of them. China is slightly positive, according to this slide, but not by much. But at least they're not in the hole the way the United States is. Next slide, please. This, to me, tells me that 2008, while it gave us some relief domestically, has really hurt the United States standing globally, financially, with the rest of the world. Because here we're looking at nominal GDP minus federal debt outstanding. So I mean, just simply the fact that we have a negative number here now, and it's really fallen off a cliff. We owe so much money. And so we are essentially, I would argue, broke. We're a country that is essentially broke, still holding the world's reserve currency. Next slide, please. Now, quantitative easing, this is Lynn Alden's slide. The difference is here, it's sort of, you could say, bordering on alchemy, because we're trying to create something from nothing. We create money out of thin air, although that's always been the case through the fractional reserve banking system. In this case, the Fed itself comes in and pumps money into the system by buying treasuries. And in buying treasuries and now buying beyond treasuries, it's buying all kinds of assets in the private sector as well. It can create money out of nothing and then go out and buy everything that of value in the United States. So this is not the kind of free market economic system that I was brought up to believe America owned. But it is a system that is really, I think, running amok. 2008 was when QE was introduced. I just showed you a slide that showed how the United States, in my view, its standing has decreased very dramatically since 2008. And I think we're about to pump it up another notch. Next slide, please. This, Lynn Alden wrote an article. The article is Quantitative Easing, Modern Monetary Theory and Inflation Deflation. And I would highly recommend you try to read the article if you're really interested in the dynamics of what causes market changes and inflation, deflation, now as we're facing the problems we're facing. But this was her slide, and she pointed out the 2019 repo crisis. She talked about it in a couple of occasions. And in my view, this is really sort of the canary in the coal mine scenario for the United States economy and the markets. This was really the start of trouble months before COVID-19 paid us a visit. But where Trump was running huge deficits, spending like a drunken sailor, the banks were financing this as much as they could. The big banks are required to, the primary dealers, that's their arrangement with the government. So they were buying all the treasuries that were being put into the market to finance America's deficit until they ran into regulatory limits that were set up in 2008 after the financial crisis. Well, with foreigners not interested in buying treasuries at almost zero or very low rates, the only buyer was the Federal Reserve. But before the Fed came in, and it came in only because the rate spiked up to 10% in September. Well, the Fed jumped in and financed, and now a lot of people have sort of forgotten about this because the rates are back down. But the Fed is having to jump in with more and more money faster and faster to keep the rates from skyrocketing. Next slide, please. This is another slide from Lynn Ald, and it just shows the pink bars show foreign sector borrowing, and it's in decline dramatically. And we're seeing the perforated line, which is suggesting what we're going to need, what the Treasury is going to need to borrow. Who's going to lend it? Well, so far, we're seeing it's only the Federal Reserve. That's the blue line. But who wants to buy treasuries at zero interest rate? Who wants to buy treasuries when you get nothing for them? There's no reason to. But as Lynn Alden pointed out, that as the dollar loses its strength vis-a-vis other currencies, we tend then to see foreigners coming back into the markets. This has happened in the past, and it happened after 2008, but will it happen again? We'll have to see. Next slide, please. Now, monetary theory eliminates the Fed. Essentially, this allows the government to simply create its own money, print the money, and buy whatever it wants. It can restrain it can hold back on inflation by increasing taxes or by spending less, in theory. But how many governments do you know that behave that way? If we behave that way, we wouldn't have the trouble that we're having now. So this is not a solution to the problem. It's just less restrictions in the way of monetization of everything under the sun. And of course, the people that own the monetary system are the ones that end up owning all the assets. This is a very sad commentary, I think, for our country and for democracy and for liberties, but that's another issue. But long before COVID-19, there were problems of demographics in the United States and the aging population. States that are more socialist have been spending wildly, and now, of course, they want to bail them out. Some of that is justified by COVID-19, of course, but these are problems with student loans over $1 trillion. But now we have massive corporate bailouts for all the airlines and everything else. It's hard to see. It's hard to see how this won't end badly. Next slide. I keep track of something called the global U.S. dollar liquidity, which is the U.S. monetary base and the foreign bank holdings of U.S. treasuries, and I've done that since the Asian crisis of 1998. And as you can see, the big spike up in 2008, and now the next one with COVID-19, this is money created essentially out of thin air. Most of this is U.S. money creation out of thin air, and I'll show you a slide in a minute that will really show that the foreigners are not participating and have been participating in global U.S. dollar liquidity increasingly over the since 2008. Next slide, please. During the last couple of credit cycles, we've had the Fed has had to reduce interest rates by 5%. Well, we're starting out at a high of 2.5%. So that means and this is arguably the worst economic downturn that we've had since the Great Depression. Some people think it could be worse than that. We're looking at a 5% decline would take us to negative 2.5%. So next slide, please. Alistair McLeod, who is one of the most frequent guests on my radio show, Alistair is very concerned about negative interest rates and points out that it's different for the world's reserve currency to own negative rates than it is for, say, the yen or the euro. And the reason for that is because everything is priced, all the commodities anyway, are priced in US dollars. So the asset that you can think of that you own, if you're going to lend it to someone else, you need to have something more in return for letting go of that asset, whether it's dollars or gold or silver or copper, whatever, your house. So there's the time preference value is something that a concept that the Austrian School of Economics have understood and talked about. Well, if you're having negative interest rates, why would you want to own dollars? Why would you not want to buy gold and get a 2% return, essentially? That's more or less what you can get in the markets. Silver, copper, all those things have some time value. So Alistair's belief is if we go negative rates in the United States, which it seems we're almost going to have to, that there's going to be a problem in retaining gold, the dollar as the world's reserve currency. Next slide, please. So this is the portion of the global US dollar liquidity that is owned by foreigners. It's falling off a cliff once again. You can see after 2008, it fell dramatically. It picked up a little bit. And now with COVID, of course, the US is creating so much money out of thin air, it's pumping it into the system, that the portion of treasuries owned by foreigners is dropping very dramatically. And I don't think that this is a way of treating your friends. I mean, it's in my way of thinking, it's very much like if you own a low price stock in the Canadian, a gold mining stock in Canadian exchange, and you have 50 million shares, and the next day you wake up and there's 100 million shares, and you were the first one in, and you put your money into the system, into a deal that was the riskiest time of all, and along come the investment bankers, and now all of a sudden they own half the company. And this is what I think is happening to the rest of the world, and the other countries are not very happy about this. So next slide, please. So the issue, one of the issues, and I bring this up because I think it's a very real possibility that the U.S. could lose its reserve currency status. We're certainly seeing things heat up with the Chinese right now, geopolitically between the United States and China. But it is true that reserve currency doesn't last forever. And the U.S. has had it now for quite some time, and it is getting to the point where it is as long as some of the others. I think there's reasons to believe that we could see that change, and if that changes, it's going to have dramatic impact on America and those that are tied to, say, the G7 countries that are tied to the United States and to this financial system. Next slide, please. How high is gold going? Well, I think that's a kind of a silly question because gold retains its value, currencies do not. So it's really how far will the dollar fall? But aside from that, if you want to really have an idea of where gold is going, I would suggest you watch or pay attention to John Williams' CPI statistics. John gauges the cost of living for Americans just as the United States did until 1980, and he continues to measure that. Now, the blue line on that chart there, that is John Williams' Consumer Price Index. And the gold line is the gold price. So the gold price and John Williams' CPI fits like a glove. Now look at the red line down there. That's the United States official Consumer Price Index. There's no mystery to me why people voted for Trump in the Midwest. For the people that lost their good jobs, their manufacturing jobs that paid well, they're starving. They were hurting before COVID-19. And now they're told they can't go to work to even put food on their tables. This is the stuff of revolutions, I'm afraid. It could be. It's very, very disconcerting in many ways. Next slide, please. Now, I show this slide because the Weimar Republic, and I don't know if we're going to hyperinflate or how this is going to be worked out. Only God knows that. But the point is that there was a lot of volatility in the price of gold during the Weimar Republic. And this was a quote from James Rickards that I picked up on Twitter the other day. He said, in the Weimar Republic, the stock market started to rise with inflation, so people didn't care about why do we need to own gold. Then they suddenly realized that the currency was worthless, hence so were their equities. So I mean, it's just something to think about. another reason to own gold is because if you put your trust in paper, it's not a very good thing to do, long term anyway. Next slide. I just have to show this because I think it's just a beautiful picture if you're a gold bug. And I think it's hard to find a chart. This is the average gold price going back to 1995. It certainly is a bullish chart. I don't see how I'm not a technical analyst, but this is just beauty to behold if you're owning gold, I think. Next slide, please. All right, so the conditions for gold miners should be very good, and indeed it seems to be working out that way. I keep track of statistics that Bill Matlack at Scarsdale Equities provides, and this is a composite of various analysts, the analysts that cover these companies, and this is what they together are projecting. So you can see a considerable projected for 2020 and 2021 for the big boys. Next slide. And here's the one for the mid-tier producers. You can see some familiar names on there. They're going up from $3.39 actual, adding up all the earnings in 2018 to $11.08 in 2021. Next slide. And now for the smaller ones, the small companies, also very dramatic increase. In fact, percentage-wise, the biggest. I highlighted Premier Gold Mines because it's one of the companies that will be speaking to you in a few minutes from now. Also, the other producer who has not yet, they just started producing. We're looking at Calibre Mining Corporation, which just started producing in Nicaragua. We'll be hearing from them as well. Scarsdale hasn't picked them up yet, but they did have very nice earnings for the first quarter, and Ryan King will be telling you about that company's fortunes as well. So I think we're really looking at a time for a very good time for gold miners, though there's that maybe little consolation compared to some of the other issues that humanity is facing. Next slide, please. So these are the companies that we'll be talking to you now. Klondike Gold, Gold Source Mines, Rise Gold Corp, Calibre Mining, and Premier Gold Mines. And so next slide, please. That's really all I have, except to just leave you with this thought that I think we are at that point, for better or worse. People are going to be trading in their fiat dollars for something that's real and tangible and honest.